Hello, welcome, and thank you for joining our first webinar of 2026. And we thought, what better way to start the year than to explore where we are finding the best investment opportunities? My name is Natalie Tysoe, Portfolio Specialist for Morningstar Wealth, and joining me today to discuss our investment opportunities is Mark Preskett, Senior Portfolio Manager. To cover off the essential housekeeping first, as always, we'll leave time at the end for your questions, so please do submit them using the Q&A function on your screen. Following the webinar, you'll see a very short survey pop up, and we would really appreciate your feedback to ensure that we continue to bring you insightful sessions throughout 2026. And finally, you'll receive a CPD certificate within the next couple of days, along with links to additional resources, including access to the on-demand webinar. So for today's session, we are going to set the stage by exploring the key themes impacting financial markets in 2026. We'll be delving, should I say, into where we're currently finding the most compelling investment opportunities across different asset classes and global regions. Now, at Morningstar, we implement a valuation-driven investment approach, meaning that we dedicate a lot of time to researching investments that present attractive valuations. Given our scale and resources, we have the ability to really dig deep into the asset classes to uncover the most compelling investments, and we'll walk through what that looks like in practice today. And finally, we'll explain how our investment team incorporates these themes and opportunities into our products, our investment products, including the multi-asset funds and managed portfolios. And this includes how we balance risk and return, how we adjust exposures as markets evolve, and ultimately how we aim to deliver better outcomes for clients. Now, to kick us off, we'll look at where we've come from in terms of performance and drivers at play in 2025 and coming through into this year. Now, it's fair to say that 2025 had a few bumps in the road. Around this time last year, AI competition from China caused US technology stocks to fall in value. Soon after, we had the announcement from Trump's tariffs, which led to many speculating about an impending recession. Added to the mix was the longest US government shutdown, geopolitical tensions, conflict, and a very highly anticipated UK budget. Even given all of that, however, markets rebounded sharply from April, with many regions soaring to new highs. All in all, it was a very positive year for investors, with most markets delivering a positive return. So let's look at that return. Now, breaking that down into equity regions and sectors, we saw Europe ex UK and UK equity delivering really great returns. An outperformance we've not seen very often of late from the UK. A lot driving these strong returns was from defence, mining, and financial companies. And something else we've not seen very often of late was the underperformance of US equity, particularly when we include the depreciation of the US dollar. Now, that said, most broad market indices delivered solid returns. From a sector perspective, we saw materials deliver impressive performance, helped by high price increases from precious metals and some non-precious metals. Communication services also delivered a really strong return, helped by AI-related gains from the likes of Alphabet and Meta, both of which make up a large portion of that sector. Whereas consumer sectors struggled with defensive sectors, for example, staples, underperforming in the rally, and some consumer discretionary stocks weighed down by geopolitical uncertainty and some elevated prices. Now, finally, on this slide, we've referenced some specific areas where we're invested in client portfolios, really contributing to strong gains across our multi-asset funds and managed portfolios. Korean equities, as you can see, were propelled by companies important in the AI build-out, including the likes of Samsung and SK Hynix, with the index coming off negative performance in 2024. Mid and smaller companies underperformed, and this is an area that we view as an undervalued opportunity. And the impressive returns across emerging markets regions that Mark will go into more detail shortly. Within fixed income, we saw the higher risk element of the bond market outperform emerging market debt, both hard and local currency, and high yield bonds reaching double-digit returns. We hold emerging market debt local currency bonds in the portfolio, and again, Mark will cover this in more detail shortly. But before we get into the detail of our investment opportunities, it's really useful to cover off some of the high level themes really impacting markets. So first off, looking at inflation. Now, overall, we've seen a fall across developed markets against the highs we saw back in 2022, and we see this trend continuing. So the fall in inflation has allowed central banks to reduce interest rates. And last year we saw the Fed, the US central bank, reducing rates on three separate occasions. The Bank of England cut rates four times throughout the year, and the European Central Bank cut rates twice, although their easing cycle began in late 2020 in 2024. Now, this was really good news for bonds as yields fell and prices rose, but it's also good news for equities as investment and borrowing becomes less expensive. AI continued to be and continues to be a key theme driving market returns. Those companies that are key to the AI infrastructure build out have seen large gains, and we saw this last year impacting the likes of the US, China, and Korean equity markets. What we haven't seen as much is the second line effects where companies begin to monetize the implementation of AI across their businesses. And finally, geopolitical risk remains heightened. The world has become a more fractured place in terms of trade and alliances with very clear divisions. However, as things currently stand, the impact from the tariffs back in April has really been relatively muted as a result of delays to some of the most punitive tariffs and trade deals. And markets have really largely shrugged off the increased conflict around the world. That said, we do need to be mindful of this when we are constructing portfolios and aligning portfolios to remain resilient in different scenarios. So with that, I will now hand over to Mark. Firstly, with a very simple question, Mark, which regions are presenting the best value?
Thanks, Natalie. Hi, and hi, everyone. Thanks for joining us today. We shared this chart with a few clients a couple of quarters ago, and we wanted to update it because it does provide a clear picture in what we're seeing and kind of helps justify some of the moves away from the US and towards emerging markets that saw at the end of last year and started already in January 2026. So the dots represent the price to earnings, the forward price to earnings using consensus estimates. And you can see that, the highest valuation where the dots on the right scale are indeed in the US. And we know it's very clear that the US equity market does trade at a higher multiple than others. And you compare that to the UK in and around sort of 13 times, emerging markets on the right around 14 times. You compare that to the expected earnings per share growth. Ultimately, as investors, you're paying for that earnings per share growth, the earnings, and then also the sort of the dividend yield that you're getting. And it's been quite a sharp change, whereas the earnings per share growth in the US large has been significantly higher than most other regions for the last few years. That's come down quite considerably now, and actually, emerging market earnings per share growth is higher than the US large. I highlight the UK there, and indeed US smallers, which is another position that we have in portfolios. So really, you can see that the price you pay for those earnings is a lot less in emerging markets, and I think this is one of the factors that is driving this sort of shift of capital away from companies like the Mag 7 into emerging markets. And before I sort of look at the investment opportunities, just wanted to touch on AI briefly on the next slide. So it's clear that this is a theme that's not leaving us. We're seeing very strong capital expenditure from some very large and important businesses. And we've touched on that at the top right chart, which just compares the hyperscalers, which are enabling this build out in AI data centers. They're the capex of the likes of Meta, of Amazon, um, of, of Microsoft into AI and building out these data centers compared to a high capex, typically historically a high capex sector like energy, and it's dwarfing that. So we're seeing this, huge amount of money flowing into these data centers. And they are coming typically from profitable cash generative businesses. So for us, we're trying to think about sensibly participating in this capex cycle, which you could argue maybe indeed a super cycle. And so the way we're doing it as valuation driven investors is to hone in on valuation. So the two areas that we're trying to overweight are US communication services, which is where Meta and Alphabet are housed, and then Korean equities, which provides the two key players in that index, Samsung, SK Hynix, are building out the HBM memory chips as a key components within these data centers. You can see there, these are spot PEs, so taking today's earnings, dividing by the price as at the end of December. If you look at forward earnings, and obviously we've had some great earnings results from SK and Samsung in Q1, but the forward earnings is actually less than 10 times. So actually, we're still finding pockets of attractive valuations in a world where valuations are stretched. So Broadcom as a company, we just touch on, it is now the seventh largest company in the world. It provides switches and routers, which are another key component in this AI data center build up. Clearly, there's a lot more in the price there at 75 times earnings. So we're looking to try to sensibly access this capex cycle, which we believe has legs. So that's just a little bit on the background, and then before we move on to some of the actual investment opportunities.
Thanks very much, Mark. So, some key opportunities both inside and outside of AI, despite the price increases that we've seen in 2025. So, digging into some of the detail then in terms of where we're finding opportunities. So, we saw earlier that Brazilian equities delivered a really strong return in 2025, but this was off a bad year, falling over 20% in 2024. So, furthermore, within Brazilian equities, we've seen a lot of news surrounding Brazil, including political tensions. So, Mark, what is our view on Brazilian equity, and do we think the impressive performance can continue?
So, if we were going to call out our sort of number one investment opportunity right now, it would be Brazil. It's first up for a reason. And we've tried to sort of summarize our thinking here on this chart. Firstly, as valuation driven investors, it needs valuation support. So the top left just shows that the CAPI PE, so the long-term cyclically adjusted price to earnings ratio, a little bit more stable than the spot and the forward PE. And you can see there, at 10 times, it's offering decent value even after the sort of 40% run we saw in 2025. We have this idea of an easing cycle. So the chart on the top right shows the Selic rate, which is their interest rate, which is currently at 15% relative to the earnings yield. So the reverse of the PE. So the earnings yield is around 10, PE is 10, so the earnings yield is around 10. So investors have been getting more return from bonds and cash, and we can see that in terms of institutional investor flows in Brazil. And we would see that gap will close over the coming months and years. And then we have the geopolitics. Typically when you're looking for valuation opportunities, it's either geopolitics, internal politics, or company specific news. Here, it's very much centered around an election cycle that's coming up in Q4, Q3, Q4 net this year, and then also tariffs. So I'll just touch on that a bit as we go through. So the first piece on the next slide around the easing cycle. So we have a very interesting situation in Brazil where we have falling inflation. So the inflation target is 3% with a 1.5% tolerance band, and the latest print is at 4.3. So great, we're back in that sort of that band, that range that the central bank is targeting. Yet we've got there with incredibly tight monetary policy. So the Brazilian interest rate is currently at 15%, which gives you a real yield on the Selic of around 11.7, which is incredibly attractive for in the grand scheme of things. And we're seeing a lot of EM debt managers going overweight Brazilian bonds as a result of that. And we see that we can see on the top right, we've just put sort of consensus inflation expectations. That inflation should start coming down even more and allow the central bank to start cutting interest rates. And what's that meant? And the bottom right is this is just showing Brazilian equity flows by participants. So that the light blue line is showing institutional outflows from equities. If you're a pension, multi-asset pension fund manager, and you're looking to match liabilities, and you can get a nearly 12% return on your cash, it's a very rational decision to sell down your equities where there is more risk and more volatility to buy bonds and cash rates. And we are seeing institution foreign investor flows, but that's being outweighed by this sort of strong selling by local institutions. And we can see that with the AUM of Brazilian equity funds is still pretty small. We're talking to some big players in the market running sort of 100 million, 500 million, where a decade ago, 2 decades ago, they were running billions of dollars of assets. So moving on, the second piece is around the election. Markets hate uncertainty, and this is an emerging market, and clearly elections and political noise is heightened. Therein lies the risk of investing in emerging markets, and Brazil is no different. At the moment, you have the incumbent Lula with a healthy lead in the polls, um, sitting campaigning against basically a fractured right, and the key risk is around Flavio Bolsonaro. So his father is actually sitting in prison for an attempted coup, 27-year sentence, and he's supporting his son. He's barred from election. The sentence is being contested, of course. Um, and therein lies the risk. And we have seen whenever there is talk or news flow in and around Flavio and his father, the equity market does tend to sell off. So it is creating some volatility. But while we're not political experts, we don't have an edge on forecasting elections. We do see this as a reason for some of the volatility, for some of the discounts. And, we are encouraged that, whereas previously the US government and the Trump administration were firmly behind Bolsonaro and actually was the justification for some of the tariffs, the 50% tariffs. But the line is now open with Lula, and there's been several calls between the Trump administration, Donald Trump himself, and Lula. So we feel that risk is there, but it's maybe the worst is behind us. And that brings us to the tariffs. So currently Brazil has a 50% tariff on its exports to the US. But if you actually dig in, so there's two facts. Firstly, there's a lot of exemptions. So orange juice, oil, aircraft, and actually the exemptions have been increasing rather than decreasing as the two governments communicate. And so there's that piece. And then secondly, actually, only a small fraction of Brazilian exports go to the US. That has been coming down, but it's been the majority of the exports actually go to Asia, to the likes of China, to Europe, to the UK. So coffee, soybeans, orange juice, some hard industrial metals as well. So it's not the relationship from an economic and trade standpoint is actually much looser and than people think. So for us as long-term valuation-driven investors, we're being paid to wait for this even after the gains, and for us, we've been adding capital to this opportunity. So that's
Thanks very much, Mark. So moving on to China, and we've actually already had a question in about this, so hopefully it will answer that question in terms of the positivity that we see around China. And this is a position that we've held in portfolios for a while, and last year we saw returns over 20%. But what drove these returns, and do we still view this region to be an undervalued investment opportunity?
Yeah, so I mean, we have to touch on China because it is a contentious position in our portfolios. And if you go back, it was labeled uninvestable by a lot of players in the market. We saw, a long bear market, a property crisis, disappointing growth, although 5% is still far higher than you're getting in developed markets. And indeed we saw a wave of fund groups launching products EMX China. And so and it's worth bearing in mind that even an investor that doesn't like China, if they're buying emerging markets where 30% of the exposure is to China, they will have some China equity there. So it's a very important country, and from it, while and always this fact remains, it's 3.5% of the world index from an equity standpoint, but 18, 19% of the world's GDP. So it's very underrepresented in equity markets relative to its impact on the global economy. Our view is valuations remain compelling. The discount has narrowed so that you've got a really strong return in 24, another decent year in 25, and that discount has narrowed. But there are still some, I mean, we always touch on Tencent, which is a bellwether stock, a wide moat firm, largest stock in the index, trading at a decent discount to fair value. And it's a communication services firm, has similar characteristics to Meta, although the profitability levels aren't quite as high. So if we move to the next slide, Natalie. So I don't want to paper over the cracks. There are some issues around China, and our original thesis was around sort of a rise in the consumer, a stabilization in the property sector. And we're still seeing retail sales weakening. So the top right shows year-on-year growth in retail sales. And we've got a slide on the next slide on the property sector where property prices remain under pressure. So it's still a muddy picture, and for us, therein lies the opportunity. We are starting to see wage inflation coming through. So that bottom right chart, we've had negative wages now for 2 years. Youth unemployment's very high, and so just starting to lay the foundations for consumption growth there. On the next slide, is just touching on that property prices. So the average selling prices of homes is still negative, although far less negative than it was if we go back sort of 12, 14, 16 months ago at the nadir of the property crisis. And so what we've seen, a lot of what we've seen in 2025 was more of a valuation re-rating, either multiple expanded, but earnings growth was quite weak. And this is again a risk for us. But one of the new factors at play is this idea of anti-involution. So involution is the idea of sort of saturated markets having too much. It's a very Chinese phrase talking about sort of where excessive self-defeated competition. Everybody works harder but gains less. So there's actually been, it was unveiled in a government work report last year, this idea of anti-involution to try and break this cycle. So a lot of it was wrapped around worker overtime, but it also around price wars and impacting margins. So a good example is the car industry. As we know, there are some players that on the EV space that we know. BYD, it's doing very well, but there's hundreds of players in this industry, and you can see the PPI, so the car inflation has been coming down, and that has impacted the net profit margin. So there is a focus, there is an awareness of this. And those low margins do translate into equity returns. And so there's been enforcement on legal reforms, regulation, labor laws. And so again, not wanting to paper over the cracks, there is some signs that we anticipate this earnings growth to come through. And for us, again, it's an undervalued market. We're paid to wait. Um, and then I would finally touch on we talk about the pendulum a lot, and the pendulum is very much swung in the favor of corporations and the ability of firms to grow and to deliver profits. If you compare that to 2, 3 years ago, where there was a real crackdown on certain segments of the market, indeed, geopolitically, there's been a wave of leaders coming. So Keir Starmer's there today. The Canadians have been in talking about signing a deal on EV. The Germans are going. There's a very sharp geopolitical sea change that we're observing. Again, have no clarity on this, but I feel it has to be seen as a positive sign.
Thanks very much, Mark. So turning to fixed income now, but sticking with emerging markets, we saw this area outperform other bond markets in 2025. But what does this investment offer in terms of income, return, and risk, Mark?
Yeah, so bonds are back just generally. We're getting positive real yields now across the DM and EM space on the sovereign side. So gilts have got offering an attractive yield. Treasuries are. You've seen Japanese government bonds sell it, delivering much higher yields today than previously. But the daddy of them all is emerging markets. And this is we've just tracked here the real yield of EM local currency debt. So these are bonds issued in their local currency. They tend to be the higher credit rating, the countries with a higher sovereign credit rating are able to issue their bonds in their local currency. If you look at the competitors, the hard currency debt, where the bonds are in dollars, they're often much more focused on the frontier markets, some of the oil producing names. So, but the local currency debt, really nice real yields. And we're going back sort of 10, 12 years, getting close to all-time highs in terms of that real yield. We're also, if you give this market to an active manager, we're getting yields of north of 9%, which is what we do for a lot of our portfolios. So, and it has indeed been one of the best performing parts of our fixed income book. And then, what do you get for that yield, and what are the risks? Looking onto the next slide, Natalie. So, ultimately, we're seeing fundamental strength in emerging markets, and this is driving some of the flows, not just in debt, but into equities. So what do we mean by stronger fundamentals? Here we're focusing in on debt to GDP relative to economic growth, improving credit ratings. And so we've got 6 of the 7 G7 here, just typically higher government debt levels compared to emerging markets. And that is not going unnoticed by investors. So, and you could argue in the US perspective, in parts of Europe, that the taps are still on in terms of government debt levels. And so, very much a credit improvement picture as well, alongside these attractive yields. And finally, the dollar is a key risk for emerging market debt. So 2025 was typified by a weaker dollar. Actually, and then we've seen sort of pockets of weakness already this year. And so while we believe that the dollar remains the reserve currency of the world, I think it's, clearly investors are looking to diversify away from the dollar. It's manifesting itself in the price of gold as well. And this is all good news for EM countries who do have dollar denominated debt, and it makes this easier to service. So all in all, you're getting healthy yields, improving fundamentals. For us, this is a great story for our portfolios.
Thanks very much, Mark. So, moving away from emerging markets now and actually turning to our home market, we've had a long-standing position within the UK. Therefore, it would be really remiss of us not to mention this area given the impact that it has on portfolios. So, Mark, over to you for our thoughts on the UK.
Yeah, so I mean, I touched on it in the outlook. If you were lucky enough, if you dialed into that, and it is our home market. So firstly, we're not. We have a small to moderate overweight to the UK, so it's nowhere near taking up as much risk budget as say a Brazil or an EM debt or even a China. So, caveat that, but it is very important, and we do still have capital there. And so, firstly, from a macro perspective, we are seeing inflation easing after a difficult 2025, driven by a confluence of factors. Some of them political, driven by changes in budget, NI changes, etc. But also wage growth has been strong, housing, food inflation. But we have our base cases for CPI to be back at that 2% target by 2027. And why is that? And we are paradoxically seeing a little bit of labor market weakness, which makes that wage inflation less evident. So the blue bar at the bottom just looks at the number and the rate of change of payroll employees. So irrespective of how well remunerated these employees are, it's just the number, and we're starting to see that fall into negative territory. So the number of employees is shrinking, and that indeed is correlated to that slight tick up you're seeing in the unemployment rate. So what are our forecasts? So next slide, Natalie. Again, we're not macroeconomists, but our edge isn't on the macro side, but we do have economists that that work with them, and we've got 5 25 basis point rate cuts penciled in for the next sort of 12 to 18 months, which brings the bank rate back to 2.5%. That has if that does come to pass, we'll have positive ramifications for things like mortgage owners and companies looking to take on debt to expand and grow. The money market prices is just 2 to 3 rate cuts over that same time frame. Currently, we've got the 5-year swap rate, which is very important for mortgages, around 3.6. So, the market's taken a little bit more of a more conservative view on that rate cut environment. Maybe we come somewhere in the middle of the two, but we do see rates coming down, and so one of our overweights is on UK gilts, and we do see that was a key driver of returns last year, and we do see this as a positive piece going forward. And we talking about this in our quarterly update, but we lucky enough to go around the houses, and we own PIMCO funds, BlackRock funds, Royal London funds, and it's becoming almost a consensus trade to be overweight UK government bonds, attracted by that high yield and that waning inflation. So we're seeing some of the largest institutions in the world sort of taking positions into UK gilts, which is great news for the asset class. And then, we still have a valuation play in the UK, and it's not as obvious as it has been, but it is there. So that sort of 14 15 times PE, and compare that to the 22 times in the US on a forward basis. Still that discount is there, and we've been tracking flows. I spoke to the Telegraph on Friday about negative fund flows in the UK, and it's there. The data is clear. But I want to put that in perspective. And this is coming off of a great year. 25-30% returns from UK equities. So firstly, what we can see, investors still moving their home bias. And Vanguard have just announced another cut to their home bias for their very successful life strategy. We're considering it as well. And it's also been a very difficult year for active managers because of the narrowness of markets. But ETF flows are positive to the UK. So this represents new money. And when we track foreign money as well, we're seeing quite a lot of money coming into the UK and a lot of global managers moving overweight to the UK on valuation growth. Why is that? And so we touched on a few things there. That, we are home to some high quality global businesses. We see financial firms to benefit from relaxed capital regulatory rules. We've got healthcare and consumer staple sectors less sensitive to economic downturns, offering great great value, and UK companies are buying back shares. We could see that, plus the dividend argument as well. So, what while we're maybe after such a great year, we're not as table thumping on the UK as we were. We still like the market and believe it's worthy of capital allocation in portfolios.
Perfect. Thank you
Thanks.
very much, Mark. So we've explored in detail some of our key investment opportunities, and that we've identified through our valuation-driven investment approach. But what does this look like in terms of overall market backdrop, especially as we've seen 2025 deliver such impressive returns and seemingly investors are more optimistic despite some of the negative events that I mentioned at the beginning of the presentation?
Yeah, great. So as you know, we try and um, capture risk taking and whether we should be adding or taking away risk with a few metrics. It's very easy to get sideswiped by geopolitics, fears of recession, and the market keeps grinding higher. And actually, being too defensive is, we can lose client gains and capital. And so the way we do it is track three, big picture aspects with a lot of data. And so our view is a sort of a low to medium. So we've got a 5 point scale, low to medium, saying we'd say it's sort of amber. Um, Sorry, Nat, you just fat fingered through this cycle. So yeah, so firstly on the capital supply, this is just looking at sort of private equity activity, M&A, IPOs, and just trying to aggregate this up. And we've got this at medium, so it's okay. We're definitely seeing a lot of M&A picking up, a lot of IPOs in China and Asia. It's been a record year for IPOs in Hong Kong, but debt deal terms are reasonable, as is secondary offering activity. Secondary offering activity is companies issuing debt, issuing equity to raise capital. And actually, we're seeing the reverse. We're seeing companies buying back shares because they believe that they're undervalued. So, capital supply, all well and good. We've just downgraded our investor risk aversion. So we are seeing investors increasingly bullish, the use of margin debt rising. It's just on the cusp of low. But it is something that we're observing. So if we cast our mind back just 3 years ago to 2022, where we had the meme stock SPACs, we had a much lower score. It was a proper low. So we're not quite there yet. But it's just definitely something, investors are overweight equities, and you can see that in fund manager surveys. And, when markets go up, markets that hit all-time high, you do get this momentum behind equities. And then on the valuation, which is actually the most has the most efficacy, it's the piece that we spend most time on, is just in aggregate how the valuation's looking. And so clearly US valuations, tight credit spreads, evidence of froth in the market. But we are seeing signs of opportunity, likes of Brazil, the likes of Asian equities, China. parts of Europe, and then the fact that growth versus defensive stock valuations are not an extreme. So, some of the cyclical areas of the market, which normally are expensive, like consumer discretionary, are actually trading at very low multiples and are providing opportunities. So there we're low to medium. So, we're not battening down the hatches. We still think there's more room to grow, and we haven't, our risk taking is at normal levels as a result. So, and the final piece on the portfolios is just, how we're positioned. As you know, we're very happy with that 2025 was a great year for our portfolios, and it's because of those return drivers, we managed to tap into some of those really strong gains, especially in the emerging markets. Our diversifiers didn't work so well. So we are thinking of outside of alternatives, we are thinking of trying to protect in a more volatile world. And I think, where we see valuation support is in staples and healthcare, much more resilient in terms of earnings stability. Government bonds provide a really good ballast for the portfolios, higher yields. And if there was a recession, we would expect these assets to get a bid. So we're trying to think of this in this sort of diversifiers and return drivers. Our portfolio construction is crucial to how we've been able to deliver such strong returns in different market cycles. But the return drivers are really driving us. And year to date, we've only 29 days into January. Our portfolios are already up sort of 2-3%, and it's driven by some of those return drivers like Korea and LATAM. And then this just exemplifies this on the upside downside capture. So, but how well we've been able to protect. So if you look at the moderate portfolio, in an ideal world, you want the upside capture to be greater than 100, i.e. you're capturing more of the upside, the downside capture to be lower than 100. And that's very much the case for moderate and above. On the lower risk portfolios, we've been running quite long duration positions, and we battened, sort of reduced our credit risk maybe a little bit too early, but we're still outperforming, but just with a little bit more emphasis on the upside and the downside. But that picture from moderate and above is really pleasing over 5 years. And then, so just the final slide from me before handing over to Matt, and then we've got 5-10 minutes for questions if you have any. So please use the Q&A or function to ask questions. But AI, we believe it's a continuing theme. We're doing a lot of work to try to find pockets of opportunity, speaking closely to our equity analysts who cover the stocks on a day-to-day basis. And indeed, Meta's results today, the stock is up 7.5%. It's dragging Nvidia up 7.5% on market close. This is, the earnings growth is real for the near term at least. Valuation driven approach, central to our process. It keeps us on the straight and narrow. Once we have a fair value, we're happy to take profits. And then we're really trying to position the portfolio for different scenarios. We haven't ruled out a recession, more difficult times ahead. We have these positions. They didn't work in 2025, but they're there for you and for your clients if markets do get a bit tricky, and that downside capture, we're confident we'll be able to achieve similar levels if markets do take a turn for the worst. So that's enough of my part. I'll pass over to Natalie.
Perfect. Thank you very much, Mark. All really great insight there. As Mark said, do keep your questions coming. We've had a good number in already, but do keep them coming in. If we don't have time to answer them in the webinar today, we will get back to you separately. So just before we do, I do kind of start with the questions. Mark mentioned it just as a reminder that some of you may have seen at the back end of last year, we launched our 2026 investment outlook, and this really brings together the insights from more than 400 internal investment professionals within Morningstar from around the world. And this was really devised to help advisors and investors prepare for the year ahead. So if you missed this or the webinar covering those topics, you can listen on demand. So thanks very much for listening. One thing that I did want to cover just before we head over to questions is how you can access some of the great work that we do at Morningstar. So we have a number of products that are really designed to empower investor success. So first of all, with our platform, we have it's based on our own proprietary tech, which allows us to be more flexible in terms of what we develop in what is a very much an ever-changing environment in terms of the needs from clients in terms of the platform. We also have advice practice technologies with Wealthcraft and our profiling tool, Phonometrica. And last but not least, as we've mentioned, and as all these investment opportunities that Mark has gone through are implemented in our investment management, so our managed portfolios and multi-asset funds. And just to briefly cover these, excuse me, our Morningstar managed portfolios, first of all. So all of our investment products are managed in line with the same investment process as we've talked about today, but the implementation is slightly different depending on the wants and needs of clients. So our active, passive, and blended portfolios, as the name suggests, in terms of the implementation of the underlying funds within that across 5 different risk profiles. Similarly, with our ESG governed and international portfolios and our income portfolios, where we have 2 risk portfolios, and they're really designed to generate a good income for clients for those who need that. And then finally, our unitized investments, so our multi-asset funds, these just passed their 5-year anniversary in November last year. So the 40, 60, and 80, which were the first ones to be launched, they relate to moderately cautious, moderate, and moderately adventurous, and the 20 fund representing the cautious fund. So within this, for clients and advisors who need it. So, for example, to you have more control over CGT, for example, a useful alternative within the multi-asset fund range. So thank you very much for listening. As I mentioned, once I close off this webinar following the questions, there'll be a short survey. Do please fill that out. It's really useful to know what you want to hear so that we can plan our events going into throughout the year. As I said, CPD certificates will be available shortly. This webinar and all of our others are available on demand should you wish to revisit that. And we'll be sending out the supplementary resources, which includes the webinar on demand. So with that, I will stop sharing the webinar and I will move on to questions. So first question, Mark, for you is around the question that we keep getting asked from advisors is around are we in a bubble? Now, we've seen a lot of the markets, as I mentioned at the beginning of the webinar, ignoring a lot of the risks that we saw last year, a lot of the events that we saw last year, when we really saw markets rallying as we looked at throughout this webinar. So, what is our view on this bubble that keeps being talked about, and what factors are we considering?
Yeah, I mean, I think it's a, tried to touch on it in the presentation with our sort of assessment of, we call it the aggregate reward for risk, and we're just, tracking capital cycle, market cycle measures. And typically, but what is a bubble? Where when investors are incredibly bullish, valuations are really high levels. This is how we're defining it. And then, companies are issuing equities, issuing debt at outrageous levels, and us as the investors are having to swallow this. And so we don't think we're there yet. What we can see, equity markets are at all-time high, but equities should rise with earnings and with the dividend yield that is and through share buybacks, etc. So, our lens is a little bit overvalued relative to history, and investor behaviors are starting to show a little bit of froth. But then the big players, the capital supply name, the sort of the IPOs, the debt issuance, it's not really there. What could trigger us, and one thing is, and I've been talking about this, is we have potentially 3 massive IPOs on the horizon in terms of the ChatGPT affinity and SpaceX. So, may these are you could question mark the earnings of these companies relative to the capital allocation they might receive, and that will suck a lot of capital out of capital markets if if they all come through at one year. And that, maybe that could be the signal at the top. But for us, we don't think we're in a bubble, honestly. We've been reducing risk a little bit, so the observant clients of our portfolios will notice we've reduced equities on the margin from a sort of couple of percent overweight down to sort of more neutral levels. We don't have much credit exposure, but we do have risk in the portfolio through the emerging markets. So, famous last words. It could all happen. It could all collapse next week, and we just don't have a crystal ball. But our sort of best estimates is that we're okay. And on geopolitics, I think there's a bit of geopolitical fatigue. Ultimately, the market seems to ignore more and more the prognosis. So on Truth Social, Donald Trump is, announces hundreds of things, and maybe 1 in 100 will come true. 5 in 100, I don't know, but we're definitely in a new paradigm where it's a lot, the sort of you know, but whether that's enough to trigger a market, a pronounced market fall is debatable.
Perfect. Thank you very much, Mark. Yeah, if only we did have a crystal ball, but great answer there. We have had some comments around China, and particularly around the kind of negative noise that we're seeing out of the US. And so my question to you is, are we seeing other investors kind of avoid China from an investment perspective because of some of the negativity that we are seeing coming out of the US?
Yeah, so I mean, section on China. I mean, just our at Morningstar at the corporate level, we're getting a lot of our information from our Chinese-based equity analysts. And so we have a team on the ground covering the stocks in the market, based out of Hong Kong and Singapore. And so we're getting great insight into Chinese companies, what's happening on the ground. They're updating their fair values. They've been very, very consistent with their view that there's undervaluation in the likes of companies like Tencent when they take a normal sort of earnings and profit, assessing their sort of long-term potential to deliver earnings growth and profits for clients. So we have some insight. Clearly, there's there you need a margin of safety when investing in China, and there we it is very polarizing for when I sit round tables in London with lots of other asset allocators, and some are avoiding China and some are embracing it. So, and what is the right answer? Our view is that in a diversified portfolio, it's worth some capital ultimately. So it's one of many bets. So for me to, we've profit our bull case for China, in its ability to outperform or to deliver, also like the diversification benefit of China. It does march to a different drum. There's a lot of internal drivers to that stock market out with of, say, a UK mid-cap thesis or a Brazilian equity thesis. So, it's diversifying, it's undervalued. So we've taken a small piece, but we're trying to find as many of them as we can. So, and indeed, we're starting to see flows. So these are all just anecdotes, but a China Federated Hermes have a very successful Asia franchise with an overweight to China. They had a breakfast with their China fund, which had raised nothing. They'd launched it at the eye of the storm. And I was expecting, a handful of asset allocators and fund selectors to be at this breakfast, and it was full to the rafters. 50, 60 people all clearly trying to get a grip on the China story. So, that interest is there. The economy is dynamic, and there's, on the you could I think it's fair to say they're sort of winning the EV car race. And there's at certain areas of the market where they are pioneers. So that all makes us believe it's worthy of a small risk allocation in our portfolios.
Great, thank you very much, Mark. Some really useful points in there, and I think one to draw out as well is on within the 400 investment professionals that we have within Morningstar, we do have local presence in a lot of these markets. It really does help us improve our investment decision making, given that we have kind of the boots on the ground within these regions, giving us extra information. So thanks for that. We have had a question on gold. So gold has you know, delivered impressive kind of price increases this year. The question is around is what has driven that and what is our view on gold?
Yeah, I mean it's a tricky one. We're not gold experts. Clearly, we haven't had it in portfolios, and that's been a drag relative. It's not in our benchmark, or but relative some peers have held gold or gold miners who have had an incredible run. So, and it doesn't have any cash flows, so it's very difficult to value. So it is a real, what we're seeing is a lot of momentum behind this market. Number one, so where are the flows coming? Could be CTAs, sort of trend following commodity, managed futures funds. It could be individual investors. It could even indeed be central banks diversifying out of treasuries. And anecdotally, you're hearing about the Indian central banks and the Chinese central bank. But, the data's not that clear, honestly, on what is driving it. It is also incredibly volatile. So especially gold mining shares, they sit right out there in terms of volatility. So, you know, this juncture, we're happy to observe. Perhaps we could have held some gold miners, and some of our active managers in blended, and some of our UK managers held a bit of gold. We do have a trend following strategy as well, which would have captured some of it in a managed future strategy. But um, it, it it's one that's sort of beyond. We don't really have any extra insight outside of what we're seeing and observing, and so that's all I would really have to say on that one. Thanks.
Thanks very much, Mark. So final question is around Korean, especially the Korean equity market. So it's almost doubled in the past 12 months. What's more, you mentioned this in terms of some of the companies within the Korean stock market already relating to AI. So do we still see this as a compelling investment opportunity?
Yeah, so this has been our gold in a way. So it's up 120% since we bought it, and we've been taking a bit of profits when we rebalance, etc. So, it comes back to this idea, the two companies that are driving this are SK Hynix and Samsung. SK just this week announced, gangbuster earnings update, and the market is taken notice. And we do believe that there is legs to this AI build out. So, and then I touched on the earnings. So that earnings is there. The price is risen, but the price to earnings is still palatable. So we've taken the decision to, take profits, but retain the overweight. So, and it has been the right decision. We've been debating about profit taking on Korea for the last 6 months, and it just keeps rising. Um, so but we're mindful of the fact. I mean, we actually owned Korea back in 2019, 2020. And I was looking back at the sort of the trade files, etc. We got it to a 3.5% position, and we zeroed it in one rebalance. So there's nothing to stop us one day. Just I think the time is right to really move out of the portfolio. But at the moment, we're still reasonably happy with the position.
Great, perfect. Thank you very much, Mark. A great portfolio driver in Korean equities last year. Well, that's all we've got time for. Thank you so much for all your questions. Thanks very much for joining. A big thank you to Mark for running through all our some of our kind of key investment opportunities there. As I mentioned, please do fill out the survey, which will pop up just in a moment's time. And all that's left for me to say is thank you very much for joining, and I hope to see you on the next webinar.
Cheers.